Welcome back to Making Money Matter, ladies and gentlemen. My name is, as you know, Kerry Stevenson. I am pretty excited because I'm sitting here in Zurich, Switzerland, a long way away from home, and I've asked Matthew Piepenburg. He is the partner for Matterhorn Asset Management, lovingly referred to as MAM, and they are based here in Switzerland. And Matthew has a background in legal matters, in investment banking. He's been a partner of Matterhorn Asset Management for how long now, Matthew?
Almost 4 years now.
Almost 4 years now. Now, Matthew and I met at the Royal Investment Symposium. We had a great chat there. And I've come over to Zurich. I'm going to the LBMA conference in Barcelona, but Matthew has been very kind to give me some of his time because it's so important that I get you, my beautiful audience out there, to understand some of the things that are going on out there. But before we start, Matthew, great to see you. Thanks so much for your time today.
I'm looking forward to this conversation. There's a lot to cover. Yeah.
There is a lot to cover, but before we do that, just who are you? Because my audience out there are going, Matthew Piepenburg, partner, Matterhorn Asset Management. What's your background?
Well, as you kind of alluded, I mean, I joke I was a lawyer for about 10 minutes, and a very good friend of mine from high school and college, during the dot-com bubble in the late 90s, decided to go from investment banking into a hedge fund. And I remember it was a big joke for my wife and I because I didn't know a stock from a bond, and it's the truth. I was an accidental tourist in the hedge fund space. This was a time in the late 90s when IPOs and pre-IPOs were ripping out of San Francisco and the West Coast, and a couple young, kind of dumb 20-somethings like us got very lucky. We started this hedge fund, and within 3 months we got an IPO that Goldman Sachs was underwriting. We were those guys you'd love to hate. It was kind of like the Bitcoin story. We made a few IPO investments. Many of them struck out. One did extremely well, and before you knew it, before I was even 30, we hit a home run with one of these IPOs. And so, who was Matthew Piepenburg? He was a lottery ticket winner in his late 20s during the NASDAQ bubble, and then became an educated investor after I made a lucky amount of money during this bubble. And that was in 1999-2000. I'm trying to do this as quickly as possible, but ultimately you win a lottery, then you have to then become responsible for the money, and then you have to allocate that money to other smarter people. And that's really where I got the education in risk assets, in stocks and bonds. And we pooled family office money together, so it was an even greater amount of money. When you're looking at larger AUM, you get in front of some of the best portfolio managers in the world, in London and in New York and in Chicago and in Frankfurt. We were flying all over, throwing money out the window in some cases at film projects and silly things. In other cases, really, really smart credit managers and equity managers and multi-strat managers and private equity. So that's when my education in risk assets and investments really started, back in 2001, 2002, after the dot-com bubble crashed. And you know, you fast forward to today, 20, 30, almost 23 years later, it became really about how do you preserve wealth and not just how do you make wealth. And of course, for me, everyone's different. People have different motives. I totally understand the speculation side, the need to find some way to quick income. Gold is not that. It's not a get-rich-quick asset. And for many people, it maybe isn't the speculation asset that they want to talk about. But for those who are interested in wealth preservation or stores of value, it's a very obvious choice. And you know, we have clients now from 90 countries. Our minimums are very high. These are very sophisticated clients from all different types of backgrounds, but we all have one thing in common. We're worried about currency risk. We're worried about banking risk. We're worried about market risk. Gold is not the only answer, but it's certainly a timeless answer. It's an important answer. And for me, gold became an education slowly beyond just stocks and bonds and ROI and all these different VAR terms and Sortino ratios and all the hedge fund lingo. I became, I hate to say it, kind of boring, but more intelligent. And so gold became a very important part of my thinking in the last 10 years.
I guess one of the things, as you've been telling us about your background, that was a lot of speculation in that sort of dot-com era. And you're now talking about gold, which is the antithesis of that. It's not speculation. It's very much gold is money, and it's, as you say, it's boring. Is there room for both? Is there room for, let's put some money aside for boring and let's have some speculation?
In terms of precious metals or just in terms of a mentality?
In terms of a mentality.
I think it's absolutely important. It's very easy for someone like me who got lucky in the 90s to talk about how speculation is dangerous. So I wouldn't be able to talk about it if I hadn't speculated. Exactly. So I'm not here to poo-poo speculation or to dismiss the need to try and make it in this market. It's a very dangerous thing to do. Most of it's luck, especially in my case. And I've known some very smart portfolio managers, long and short, who have all the skills, all the Bloomberg screens and all the analysts, and they can still be humbled by the markets. It's a very dangerous place to tap into, to toe dip into. Many times it's the trend is your friend. And many times very successful managers were really just like me, lucky. But it's not an irrelevant question to try and find a way to speculate, to make your income grow. There's nothing wrong with that, and we can talk about ways that can be done.
Yeah.
For gold investors, not gold speculators, not
Yeah.
going long and short or playing the COMEX or trying to get
mining equities.
Exactly.
Yeah.
And there's great value in mining equities if you have the patience for it. But for those, most of our clients, they're past that stage in their life. So
Okay.
we're not always everything to everyone. We really aren't in our particular business model, in our particular asset class in physical gold. But of course it's important to try and find a way to find an opportunity to find value. Everyone says, buy low, sell high. Almost no one does it. This is a very topping market in real estate, in credits, and in equities. It's very hard right now to chase a top and find the next thing. It was crypto for a while. Maybe it's artificial intelligence. There are trends you can catch, and you can try and short a topping market, but that can be incredibly dangerous when you're fighting central bank policies, and you're basically looking at higher low interest rate policies to turn the market direction. So you're really timing central banks, not timing balance sheets or financial statements. And looking at, Sortino ratios, or looking at Bollinger Bands or Keltner Bands, or, DeMark indicators, which really smart portfolio managers know how to do. But even the smartest guys can get humbled in these markets. And luckily for me, and I'm, again, being very humble myself because I know I was lucky. I wasn't skilled. But there are smart people who can make money in these markets. It's very hard right now.
Why do you say that?
Well, for one thing, it's hard to find value right now in any jurisdiction other than maybe emerging markets. And you look at the S&P or the Dow or the NASDAQ right now. The S&P 500 is really the S&P 5 or the fabulous 7.
Yeah.
You look at what ETFs have done to distort price discovery in other asset classes or other stocks and bonds. There's really not a robust S&P. You have a small handful of companies that are leading the way. It's hard to really look at the old rules of good balance sheets, good financial statements, good growth in a company, smart management. For so many years when the Feds had the zero-bound interest rate policy, a monkey could make money on the markets. Really, a CEO didn't even have to have skills. You could use really cheap debt to buy back your own stocks, to squeak your earnings per share data. You could do a lot of things to extend and pretend using the low interest rate backdrop, where you could borrow and fake it till you make it, or just fake it, period. And even the big 7 are facing earnings problems. You've got Goldman Sachs making layoffs. You've got Amazon and Google making layoffs. That's because their earnings are actually not that robust. They wouldn't be laying off 10 to 18,000 employees. It's very hard to find a good value in your standard stock, or certainly in the credit markets globally or in the U.S. When rates are going up, bonds are getting shellacked. And if you looked at 2022, we had the worst combined stock and bond return since 1871. That's not just something you say.
Can you just repeat that?
Yeah, 2022, on the back end of Powell's higher for longer policy to fight inflation, it was, bonds are supposed to zig when stocks zag. They're supposed to be our grandfathers and fathers' safety asset. Well, bonds got clobbered at the same time stock got clobbered last year. So there was a correlation rather than a hedge going on with credits and equities. That was a very telling point. Because obviously when you raise interest rate, bond prices are going to go down, and bond prices really went down. And then we, of course, had a banking crisis in early 2023. That really wasn't a banking crisis; that was a bond crisis, because banks use U.S. Treasuries or government bonds as collateral. Well, they were buying those bonds at a high during the zero-bound interest rate policy for years. The Fed had basically kept rates so low that bonds were a bubble, and people were buying at the top. These were the smart guys, the SVBs of the world.
Because they never thought it would change?
No, they just assumed tomorrow was going to be like yesterday. So they were buying bonds at the top. Then comes 2023, rates are going up at this incredible pace for Powell's war on inflation, and those bonds sank to the ocean floor. And so all that collateral at those banks, it wasn't just bad tech loans or crypto loans, it was just U.S. Treasuries, long-duration U.S. Treasuries, which went on their knees, and that just destroyed the collateral of a lot of these banks. And I frankly don't think the banking crisis is over. Those are very important crises that we've just kind of out of sight, out of mind in the last few months, just kind of forgot that.
Isn't it interesting? Because it was, and I think I heard Egon von Greyerz, your partner, say this recently, the Ides of March, which was when the four, the Silicon Valley banks, etc., we have forgotten about it, haven't we? And we've said, oh, yeah, that was just a blip. And life will go on. Is there a lag effect in what's happening with the economy at the moment? Because it feels to me like everybody's saying, nothing to see here, nothing to worry about, and people are getting suckered in, and that potentially there could be an even greater. And look, we're not talking catastrophe here. We're just saying, be aware. I'd love to hear your thoughts.
Well, in a lot of ways, I was talking about this recently. One of the great sins is the sin of omission, right? We have a lot of politicians and policymakers right now using platitudes, as I've always said, to hide very bad math. Right now in the U.S. in particular, there's a big debate about a hard or soft landing. To me, it's not even a debate. And again, it's not being a hyped gold bug or gold bull. there's nothing soft about what's happening in the U.S. right now. You've got a 25% increase this year over year, in bankruptcies in the U.S. You have foreign companies going bankrupt. You've got Goldman Sachs making layoffs. You've got Amazon and Google making layoffs. You've got Spotify making layoffs. And yet they tell us we have a robust labor market. First of all, that's a lagging indicator. By the time the NBER tells you you're in a recession, we'll be a year into a recession.
Yeah.
So there's nothing soft at all about what's going on in real time right now. They use this idea of a resilient market or a resilient labor force, but that's quantifiably not true right now. And even the market highs this year, the rising S&P, you have to remember the S&P was down 15% last year, 30% for the NASDAQ. We're just running uphill in roller skates. We're not ripping. We're just trying to capture our losses from last year.
Right.
So the markets aren't resilient. Labor's not resilient. The economy's not resilient. I was joking with another colleague the other day that if you call this a soft landing, the engines are on the runway, the wheels rolling down the hill, and the passengers are screaming from the fuselage. But the press isn't talking about this. And this is very common, whether it's in a military catastrophe or a financial catastrophe. There's a need to be calm and carry on and keep the narrative confident.
Yep.
Whether it's on inflation, whether it's on a recession, whether it's on the markets, whether it's on Fed policy or the Royal Bank of Australia or the ECB in Europe, there's a need to protect people from panic or contagion. Again, this is not hype to say this. This is not exaggeration. This is not trying to be a gloom and doom precious metals executive, whether it's in the US or Switzerland or Australia. Some of our industry is guilty of that.
Yes.
I think we need to be more sober and just look at the evidence, not the emotions, not the clickbait. There is so much evidence of a very dangerous macro condition right now. Globally, that's even more scary because it's not just a U.S. problem anymore or a European problem. We have a problem in Asia, we have a problem in Europe, and we have a problem in the U.S. and Canada. It's a real convergence of a lot of negative factors. And to my earlier point, there is a sin of omission, whether it's in the Washington or Bezos Post, or whether it's the Wall Street Journal, the Financial Times, or whether it's at the central bank or the Fed. Powell's doing a very good job of trying to hide the reality of this math. The press is supporting, the politicians are supporting him, but the math speaks for itself. And it's quite alarming and disturbing. Whether you're looking at debt levels, you're looking at yields, or you're looking at yield curves, or you're looking at real employment, or real accurately reported inflation. It's just everywhere I look, I'm seeing very disturbing signs, and it's not meant to be clickbait fear, which is, again, I'll repeat, in our industry, especially in the retail side of precious metals, there is a need to scare investors into an asset class that you don't need to use fear tactics when the facts are as bad as they are.
And I want to talk about that. One of the things you just said, and it's clear to me, a lot of people don't want to look at the evidence. Mm-hmm. And you said a moment ago, there's a lot of evidence out there. Mm-hmm. So let's bring it back to some of that simplistic, if you like. And I'm not saying my audience are dumb by any stretch of the imagination, but I'd like to just simplify it by saying, what is the evidence that you're seeing? Because everybody out there, in my opinion, is a little bit confused. Mm-hmm. Now, they're either confused because the media is clickbaiting or actually not giving them the absolute evidence and the things that are right in front of their faces. Right. But what I want to find out from you, if you like, is what is the evidence that you think people should be being aware of and really paying attention to?
Yeah, it's a really important question, Carrie, because I think I always use the metaphor of a lighthouse in the fog. And there's a lot of fog. There's a lot of fog positive, there's a lot of fog negative, there's a lot of fear, and there's a lot of false narratives of be calm, carry on, it's okay, the Fed or the central banks have your back, or the best and the brightest know what they're doing. You separate the scary hype from the positive hype, and you stick to simple lighthouse facts. The most obvious fact, which is omitted too much from the daily conversation, whether it's in equity markets or credit markets or in precious metals or in other asset classes, the most obvious fact is debt. And global debt, well past 300 trillion. Everyone talks about the U.S., and I realize you have an audience in Australia, but the U.S. is the home of the world reserve currency, and that's the home of the U.S. Treasury. So everyone is affected by what happens in the debt markets in the United States. When the U.S. is now at 33 trillion, our policymakers, left and right, but mostly currently from the left, just added another 1.9 trillion in borrowing for the end of this year. So we're looking at literally 35 to 36 trillion going into 2024 in just public debt. When you add on to that corporate debt and household debt, you're well over 97 trillion. These numbers are an abstraction. It is the elephant in the room because the debt levels affect every other market. Because the debt levels mean the U.S. has to keep living off of IOUs. That's Uncle Sam's bar tab, as I like to call it. This is not sensational. We are living well beyond our means as a nation. So when we have to live off of IOUs, not GDP and not tax receipts, we are literally living on borrowed money. That debt, those IOUs go out from the U.S. Treasury and the Congress, But then who pays for that debt? It's not foreign borrowers of U.S. Treasuries. Last year there was a classic dumping of U.S. Treasuries by foreign central banks and a stacking of gold. But if no one else is buying our Treasuries at a meaningful level, that means our central bank has to buy those Treasuries. That means they have to literally mouse-click money out of thin air to create liquidity, to monetize our own debt. That sounds like a intellectual or economic argument. That's just a 10-year-old would know that when you're mouse-clicking money out of nowhere to pay for your government debt, to keep your bonds bought because no one else wants these otherwise unloved bonds, you're distorting bond markets, you're distorting bond yields, you're distorting currencies. That's not a gold bug argument. That's common sense math that no one wants to talk about. So to your question, when your viewers or your investors or your listeners are confused, of course they're confused. They're hearing all kinds of different narratives. And I think keep it simple, stupid. Look at debt levels in general, but then look at the home of the world reserve currency, the USA. This was the country that has the iconic America, the flag on Iwo Jima, Wall Street, the great movies, the great Henry Ford stories, the rags to riches stories. This once great America, that generation and that country, that nostalgic, iconic America is now what I call a debt-soaked America. And I'm as patriotic as they come. I may be a European American, but there's reasons why you can love America for so many things. But this America is unrecognizable to me right now. This need to get reelected or popular by living beyond your means as a government, issuing far too many IOUs that no one else wants to buy, and then having a central bank monetize those IOUs by clicking money out of nowhere. That is not a sustainable policy. And it always ends in the debasement of currency.
I'm going to interrupt you there and say, why can't it be sustainable? Because you know what? We've been living on debt for a long time. You know, you can go back to Nixon taking the dollar off the gold standard back in 1971. And that's when the whole debt narrative, if you like, started. And it just continues. They'll kick the can down the road. My question to you is, no one really cares. The debt's, the numbers just keep getting bigger. And it kind of becomes, it's just a number. Matty, nothing to see here. Just because your house is going to cost you 10 million, it's just a number. So what would change that? Why don't the numbers the debt just keeps getting bigger and they keep kicking the can down the road? I guess my question to you is, will there be a time or something that happens that you think, one day, or in my opinion, I think it could keep going on in my lifetime, so why do I care?
No, it's a super important question. And, you think about it, this is an oft-repeated quote by Ernest Hemingway, who wasn't a central banker or a Nobel Prize-winning mathematician, but he said, look, poverty starts slowly, then all at once. Well, 1971, the year after I was born, Nixon got up the gold standard. You could say, well, that's over 50 years, no real problems. But this is the most kind of underspoken and ignored fact of basic math and currency debasement. Since 1971, the U.S. dollar, including all the other major fiat currencies of the world, when measured against a milligram of gold, have lost over 95% of their inherent purchasing power. So that death has been by 1,000 cuts, year after year, decade after decade. It's the unseen frog boil. You know? And so, in a way, it's already happening. The purchasing power of your dollar, or your Canadian dollar, or your Australian dollar, or is already getting neutered every single day. It's just that slow
why can't it keep getting neutered for the next century?
Because now we've hit that critical point where it's really an uh-oh moment now. Because every politician, left or right, in the U.S. and certainly in Canada and Australia, stays elected by telling people what they want to hear and living beyond their means. But I think it's common sense. I always say it's a joke. It's you have a busboy salary but a Ferrari appetite. Well, every politician does, because the voters want to hear what they want to hear, and politicians want to overpromise, underdeliver to stay in power for at least the next few years. That's all too human, political. It's always been that way, always will. But in every example throughout history, whether you go, again, I joke about ancient Rome, or you go to Persia, or you go to Pol Pot, or you go to Chairman Mao, or you go to Napoleon in the 1890s, or you go to Weimar Germany and the rise of Hitler, or Franco of Spain, or you go to Yugoslavia in the 1990s. There is no exception throughout history. This always does seem like everything's fine until it's not. And throughout history, without exception, you have a debt crisis, which then leads to a market crisis, which leads to a financial crisis, which leads to a currency crisis, which leads to inflation, followed by centralized control from the extreme political left or the political right. Without exception. You could take, I joke, you could take a compass and a calendar, and you could go throughout history and see this. What we're seeing now, with the rise of CBDC, with the rise of a corporate media, this is not exaggeration. We know that the media is now infantry for a political party. It's not broadcast journalism. It's not the fourth estate. The weaponization of so many areas of our lives now. And we feel it. We feel real inflation that's different than reported inflation. We see a recession, even though it's not reported as a recession. We distrust our squawk boxes more and more. And you also feel the inherent purchasing power of your currency getting weaker, regardless of what the reported official inflation number is. And again, you don't have to make conspiracy theories or tinfoil quacky kooky stuff on YouTube interviews to say we're in a bad place. We are quantifiably in a bad place. And I don't think it's going to take another 50 years to destroy the currency. We already have destroyed the currency. When you leave that chaperone, when you leave a teenager without a chaperone, they tend to do silly things. When you leave politicians and central bankers without a gold-backed chaperone, the currency does terrible things. It starts to party too far.
Okay.
And the debt levels are simply unsustainable now. And I think now we're hitting the exponential phase where that final straw on the camel's back. I don't know. Egon doesn't know. No one knows what will be the next trigger. We've already had a gilt crisis in the UK in 2022.
Yes.
We had a repo crisis in 2019. We had a banking crisis in the US, which actually cost us more than the 2008 great financial crisis. We have a bond crisis in the US. We have an unemployment crisis that isn't being reported. We're seeing layoffs. We're seeing bankruptcies. We're seeing on the main street from Bahnhofstrasse in Frankfurt to what I see on Main Street in the US, there is so much evidence of real strife already, not to mention geopolitical and political, which we could spend hours on each of these different flagpoles. So it's not gloom and doom. It's not the end of the world reserve currency. It's not the end of the dollar, but it's the end of a trusted inherent purchasing power of a currency, of a fiat currency. And we're seeing de-dollarization. We're seeing trends away from the dollar. These aren't clickbait scare tactics to say it's the end of the currency, it's the end of fiat money. But it's the end of that trust in it, and it's getting weaker and weaker, frog boil by frog boil. Again, I think what we're seeing now is an acceleration of things that were slowly ignored. More and more investors are more and more informed about what the Fed does or what a central bank does to
Do you think so?
I think so.
Because I'm finding that it's almost like people turn around and say, not listening, because it is just too much for people to take in. And so it's like the government's going to look after me, nothing to see here, and I'll just keep going on.
Right.
So I wonder, maybe you're seeing a different investor than I'm seeing.
I mean, I truly am a mathematical realist and a cynic. I could have my own biases that could cloud that judgment, my understanding of history, my understanding of currencies, my understanding of precious metals.
I think you've got a very good understanding.
And you always have to hedge your own convictions. If anything, I sometimes worry, I joke with my family, I almost have too much confidence in gold and too little confidence in fiat money. And where could I be wrong? I'm always thinking like a lawyer. What's the other side of this argument?
Right.
And I'm open-minded to this. I have a lot of respect for Brent Johnson, who has a strong dollar theory. He's a brilliant man. I'm not saying he's wrong or right. We need more conversations, more dialogues about this. But even Brent Johnson, who's a strong dollar proponent, ultimately agrees in the end, I'd much rather hold my currency in precious metals than in fiat money. We all have a very clear sight of the end game here, which is fiat money is dying by the day, by the hour, by the politician. It just is. To your point, it's very normal human nature to not want to see certain things. We've gotten so used to central banks having our back. There's a certain educational and professional respect we have for the institutions of central banks. I don't have it at all because I understand how the sausage is made. I've seen it. I think you're groomed to be a central banker. I think you sacrifice some of your mathematical and historical integrity for the vanity of the position, and you do your best to keep central bank policies to control, quote-unquote, inflation and employment, but they've gone way beyond trying to mandate inflation or mandate employment. They've gone into distorting natural supply and demand forces, and they've gone into taking debt levels so high that the only way to solve for that debt is more creation of money. When you add water to a glass of wine, you dilute the flavor of the wine. When you add
Don't ever do that in front of me. Just quietly, never dilute the wine.
When you add trillions to a currency year by year by year, and now at a level that's gone beyond rational, it's an abstraction, you will pay the piper for that. And that's not gloom and doom. It's common sense. Not many people want to hear it. But again, we have very sophisticated clients from many different countries who've made lots of money in the markets and outside of the markets. It's not hard to convince them to be informed. You don't also have to be a multimillionaire to invest in gold.
No.
So it's common sense. It's not get rich quick. It's a protection asset. Wealth preservation is not as sexy as wealth development or wealth growth. But you know, I've seen a lot of very wealthy families. The big joke in the family office space where I came from after winning a lottery ticket was how do you have a small fortune? You inherit a large fortune. In other words, you have to have to think about more than just throwing darts at risk and hoping to get lucky. You have to think about wealth preservation as the cornerstone of Matterhorn. It's something Egon understood 20 years ago, 25 years ago, 30 years ago. The way to be wealthy is not to lose your wealth. And again, that's not just a phrase. It's something we've seen over and over with families in so many different examples. I've seen it personally. There comes a point where you grow up from that 20-something .com millionaire lucky lottery ticket winner to let's be responsible now with our families, with our money, with our choices. It's not sexy to just talk about wealth preservation, but it's one area that I think I want to talk about, and it's what our clients need to talk about. To your earlier point, it doesn't mean I'm mocking those who are trying to find a way to grow money too.
Yep.
Even gold, when it gets to a higher valuation, when gold's at 3, 4, 5,000, that's only because the dollar has gotten weaker. So that loaf of bread or that car is going to cost more. So be careful what you ask for when gold is at 3 or 4 or 5,000, which I do believe it will be. It just means not that gold has gotten stronger, that paper, fiat, unchaperoned, worthless dollar has gotten weaker. So we're just trying to keep gold as a constant, as a store of value. It will rise in speculative price, and it will go down in speculative price, depending on interest rates, depending on market swings. Gold can be very sympathetic when markets sell off for a short period.
We're gonna come back and talk a little bit more about gold and the price fluctuations in just a moment. But thank you so much. We're going to have part 2 in just a moment.
My pleasure.